Over the last 3 years, the Semiconductor ETF, ticker SMH, has turned average retirement accounts into fortunes. It's been a beautiful ride. But as we sit here in February 2026, the math of this fund has changed in a way that should keep you awake at night. If you own SMH today, you aren't just owning chips. You are currently living under what I call the 1 in 5 rule. Nearly 20% of every single dollar you have in that fund is sitting on a single desk at NVIDIA. Another 10% is sitting in a single foundry in Taiwan. If you are 65 years old, you have effectively turned your diversified safety net into a concentrated wager on the geopolitical stability of the Taiwan Strait and the quarterly earnings of one CEO. Now, here is the enigma. If you sell today to play it safe, you are walking away from the most significant wealth creation engine since the 1990s. With the cost of living in the US climbing, if you exit the AI revolution now, you aren't safe. You're just slowly going broke as inflation eats your purchasing power. You are trapped between a bubble and a slow bleed. So what if there was a way to own the AI revolution without the NVIDIA anxiety? What if you could own the software, the infrastructure, and the global giants that benefit from AI while spreading your risks so thin that a single company's failure couldn't touch your retirement lifestyle? Today, we are looking at the SMH versus AIQ battle. We're going to look at the secret 0.68% insurance fee, the tax efficiency traps that only retirees care about, and why the software shift of 2026 makes one of these a ticking time bomb and the other a generational wealth builder. If you want to retire rich, and more importantly, stay retired, this is the most important 15 minutes of your week. Let's look at the numbers.
Before we compare the tickers, we have to look at the reality of the market right now. In February 2026, the AI boom has officially entered its phase 3. Phase 1 was the hype, everyone talking about ChatGPT. Phase 2 was the hardware scramble, the massive chip buying spree of 2024 and 2025. Now, in phase 3, we are seeing capital expenditure hit a fever pitch that is almost impossible to wrap your head around. Wall Street consensus shows that global AI-related data center spending is projected to hit $527 billion this year alone. That is nearly $500 billion. But here is the catch for you, the investor. 90% of that money is currently flowing through a tiny group of companies. This is why SMH has outperformed. It is the direct beneficiary of that massive spending wall. But the market is starting to ask a dangerous question. When do these companies actually start making a profit from the AI they are buying? If you are a retiree, you can't afford to wait for the answer if it turns out to be never. You need to know if you are buying the internet in 1999, which was a great idea but a terrible investment, or if you are buying the internet in 2005, when the real money was made. This divergence between hardware and software is where the battle between SMH and AIQ is won or lost.
Let's put the VanEck Semiconductor ETF, ticker SMH, under the microscope. If you want to understand why this fund has become the heartbeat of the tech world, you have to look at the cold, hard numbers. This isn't just an ETF. For many of you, it has been the primary driver of your portfolio's growth over the last decade. But with great performance comes a level of concentration that demands your attention. As we sit here in February 2026, SMH is trading at a staggering $410 per share. To give you some perspective on how fast this rocket has moved, just 1 year ago, in early 2025, this fund was trading in the mid-$200. We have seen a vertical climb that has defied almost every analyst's bear case. In fact, SMH recently hit an all-time high of $420.60, representing a 52-week move that has seen the fund more than double from its lows of $170. This is the kind of parabolic growth that usually only happens in individual stocks, yet here it is, happening in a diversified fund. But don't just look at the recent spike. Let's talk about the long game, because that is what matters for your retirement. Over the last 10 years, SMH has delivered an average annual return of approximately 33.3%. Think about that for a second. If you had invested $100,000 in this fund a decade ago, you wouldn't just be comfortable today. You would be sitting on a portfolio worth over $1.6 million. That is the power of the semiconductor cycle. And last year, 2025 was an absolute outlier, even by those high standards. SMH closed out 2025 with a staggering 49.2% increase. It didn't just beat the S&P 500, it tripled the broader market's return.
As I said earlier, this performance comes at a cost of extreme concentration. This fund only holds 25 companies.
This is a targeted strike on the hardware that runs the world. Currently, NVIDIA, makes up nearly 19% of the entire fund. Taiwan Semiconductor, TSM, sits at roughly 10%. Then you have the supporting cast, Broadcom at 7%, Micron at 6.6%, and ASML at about 5%. This means that nearly half of your money is tied to just 5 companies. If you are a retiree, you need to understand that this is not a broad market investment. When you buy SMH, you are betting that the $530 billion in AI capital expenditure projected for 2026 will continue to flow into these specific foundries and design houses. The expense ratio is a lean 0.35%. For every $10,000 you invest, you're only paying VanEck $35 a year. This low fee is one of the reasons the fund has been able to compound so effectively. However, I have to give you the warning. SMH has a standard deviation of over 26%. In plain English, that means the swings in this fund are twice as violent as a standard index fund. While it is the fastest horse in the race, it is also the one most likely to throw its rider if the 2026 AI spending spree shows even a hint of slowing down.
Now, let's meet the challenger, the Global X Artificial Intelligence and Technology ETF, ticker AIQ. If SMH is a high-octane bet on the hardware, AIQ is a bet on the entire value chain. This fund recognizes a truth that many investors miss. While chip makers create the tools, it is the software and platform companies that actually monetize those tools to build long-term wealth. As of February 2026, AIQ is trading at roughly $52 per share. Unlike SMH's vertical, almost frightening climb, AIQ has moved with a more measured, sustainable cadence. Over the last 52 weeks, it has traded between a low of $30.60 and a high of $54. This tighter range is exactly what a retiree should look for. While SMH investors are constantly checking for a bubble pop, AIQ investors are benefiting from a smoother upward trend. The biggest difference between these two contenders is the 1 in 5 rule. While SMH forces you to rely on just 25 companies, AIQ holds a robust basket of 90 securities. This is sleep at night math. In AIQ, your exposure to NVIDIA is capped at a much safer 2.8%. Even its largest holding, Samsung Electronics, currently sits at just under 6%.
When you buy AIQ, you own the tech giants that are the biggest buyers of chips. Companies like Alphabet, Google at 4.4%, Amazon at 2.7%, and Microsoft at 2.4%. You also gain exposure to the software implementers like Salesforce, Oracle, and Palantir. This is critical for 2026. If the demand for hardware cools off, the companies in AIQ actually benefit because their cost of infrastructure goes down while their AI subscription revenue continues to grow. SMH holds the chip makers, while AIQ holds the makers, buyers, and users of these chips. Let's talk returns. AIQ may not have the 49% fireworks of SMH, but its performance is far from boring. In 2025, AIQ delivered a solid 31.9% return. Over the last 3 years, it has annualized at a massive 36.4%. For a retiree, these are dream numbers. You are capturing the AI revolution, but you are doing it with a fund that has a much lower drawdown risk. During the market tremors of early 2026, AIQ's software-heavy portfolio has shown significantly more resilient than the chip-heavy SMH. AIQ has an expense ratio of 0.68%. Compared to SMH's 0.35%, this feels expensive. But for a retiree, you have to view this 0.33% difference as an insurance premium. You are paying Global X to manage a global 90-stock portfolio that includes names in Korea, Germany, and the Cayman Islands. Diversification you simply cannot get with SMH. Now, let's talk about the retirement stress test: taxes, volatility, and RMDs. Both SMH and AIQ are ETFs, which means they are generally more tax efficient than mutual funds. However, because SMH is so concentrated, VanEck often has to rebalance the fund as companies grow too large. This can occasionally lead to capital gains distributions that you didn't ask for. AIQ has a higher turnover because it tracks a more complex index. If you hold AIQ in a taxable account, you might see slightly more tax drag. But if this is in your IRA, the fee is your only concern. Let's look at the maximum drawdown. In the tech sell-off of 2022, SMH fell significantly further than AIQ. Why? Because when the hype leaves the building, the most concentrated stocks fall the fastest. AIQ's software and platform companies tend to have stickier revenue.
People don't cancel their Microsoft Office or Salesforce subscriptions just because the market is down, but companies do cancel their orders for new hardware. For a retiree, the safety of AIQ isn't just a buzzword. It's reflected in a lower drawdown percentage. It's the difference between a 35% drop and a 20% drop. That 15% difference is what allows you to stay retired during a bear market without having to go back to work.
So, which one belongs in your 2026 portfolio? I want to be very clear. Neither of these should be your entire portfolio. We are talking about your satellite tech exposure. The strategy for the aggressive retiree under 50. If you still have 10 to 15 years before you need to touch this money, you can likely afford the concentration risk of SMH. The 0.35% fee is too good to pass up. And the semiconductor industry is projected to reach $1 trillion by 2030. But you must have a cash bucket of at least 2 years of living expenses so you are never forced to sell SMH during a crash. The strategy for the conservative retiree, 60 plus. If you are already taking RMDs or living off your dividends, or even about to retire, AIQ is the superior choice. Yes, the fee is higher. Yes, the growth might be slightly slower during a massive bull run. But your job in retirement isn't to get richer, it's to stay unpoor. AIQ gives you the AI growth you want, but it wraps it in a protective layer of 86 diversified global companies. It protects you from the NVIDIA trap. If you want the best of both worlds, here is my real wealth hack for 2026. Allocate 70% of your tech sleeve to AIQ for the broad software exposure and 30% to SMH for that extra kicker of hardware growth. This lowers your overall expense ratio and ensures that you aren't over-leveraged on a single chip company in Taiwan. And finally, for my income seekers, if you are watching this and thinking neither of these pays enough to buy a loaf of bread, you're right. If you need income, you should look at VIG, the Vanguard Dividend Appreciation ETF. It holds the AI giants like Microsoft and Broadcom, but it only picks companies that have grown their dividends for 10 straight years. It is the retirement gold standard. Click the video here for the deep dive of my top retirement funds, or here for the top 3 Vanguard ETFs including VIG. Go watch that next if you want to see how to turn AI growth into actual monthly cash flow. Invest with logic, invest with data, and I'll see you in the next video.